In the autumn of 1910, a quiet train departed from New Jersey under unusual circumstances. On board were some of the most powerful financial figures in the United States. The men on that train avoided reporters, used first names only, and traveled with strict secrecy. Their destination was a private island off the coast of Georgia. For an entire week, behind closed doors, they debated how to redesign the American financial system. 3 years later, their ideas helped shape one of the most powerful financial institutions ever created. That institution would later influence interest rates, financial markets, and even the global economy. Today, that institution is known as the Federal Reserve System. At the beginning of the 20th century, the United States had no true central bank. Banks operated independently, often with little coordination during financial stress. When economic panic appeared, the entire system could quickly become unstable. One of the most dramatic examples happened in 1907. This crisis became known as the Panic of 1907. As fear spread, depositors rushed to withdraw their money from banks. Without enough liquidity, many financial institutions collapsed. Businesses failed, markets fell, and the financial system nearly froze. At that moment, the country realized something important. The United States lacked a financial institution capable of stabilizing the system, and that realization would eventually lead to one of the most important reforms in American financial history. After the Panic of 1907, the United States faced a difficult question. How could the country prevent another financial collapse? Many economists and policymakers believed the answer was a central banking system. But the idea of a central bank was controversial in American history. Many citizens feared that too much financial power could become concentrated in one institution. Still, the memory of financial panic pushed lawmakers to act. After years of debate, Congress introduced a major financial reform bill. In 1913, that legislation became known as the Federal Reserve Act. President Woodrow Wilson signed the law on December 23, 1913. With that signature, the Federal Reserve System was officially created. Its mission was simple in theory, but powerful in practice: to stabilize the banking system and prevent future financial crises. Unlike most central banks in the world, the Federal Reserve was designed with a unique structure. Instead of a single institution, the system was divided into multiple regional banks. Today, the Federal Reserve System includes 12 regional Federal Reserve banks. Each of these institutions serves a specific region of the country. Above them all sits the Board of Governors in Washington. This board is responsible for guiding the nation's monetary policy. But the most closely watched decisions happen during meetings of the Federal Open Market Committee. The committee is responsible for setting the direction of interest rates in the United States, and those decisions ripple through financial markets around the world. From mortgages and credit cards to stock markets and global currencies, few institutions in the world hold this level of influence over the global financial system. Only a few years after its creation, the Federal Reserve faced one of the greatest economic disasters in modern history. In October 1929, the American stock market collapsed. The crash triggered a chain reaction across banks, businesses, and households. Within a few years, the United States entered what became known as the Great Depression. Banks failed across the country as depositors rushed to withdraw their savings. Businesses closed, unemployment surged, and millions of Americans lost their livelihoods. At the time, many economists argued that the Federal Reserve had not acted aggressively enough. Some believed the central bank should have injected more money into the financial system. Others argued the crisis revealed deeper weaknesses in the banking system itself. The crisis forced policymakers to rethink the role of central banks in stabilizing the economy. And the lessons learned during the Great Depression would reshape monetary policy for generations. Nearly a century after its creation, the Federal Reserve faced another historic challenge. In 2008, a collapse in the housing market triggered a global financial shock. Banks around the world suddenly found themselves exposed to massive losses. One of the most dramatic moments came when the investment bank Lehman Brothers collapsed. Financial markets froze as fear spread across the global economy. Once again, the Federal Reserve was forced to respond. The central bank began cutting interest rates rapidly. But interest rate cuts alone were not enough. The Fed then introduced an extraordinary policy known as quantitative easing. Through this policy, the central bank purchased massive amounts of financial assets. The goal was to restore confidence and restart the flow of credit in the economy. Once again, the Federal Reserve stood at the center of the global financial system. For more than a century, the Federal Reserve has played a central role in the American economy. Its decisions influence interest rates, credit, inflation, and financial markets. But with great influence comes intense debate. Some economists argue that the Federal Reserve helps stabilize the economy during crises. Others believe its policies can sometimes distort markets or encourage excessive risk. Critics also question how much power a central bank should hold over the economy. Supporters, however, argue that modern economies require an institution capable of managing financial shocks. Without such a system, financial crises could become even more destructive. The truth is that the Federal Reserve operates in a complex and constantly evolving economic landscape, and its decisions continue to influence the financial future of millions of people. More than 100 years after its creation, the Federal Reserve remains one of the most powerful financial institutions in the world. Its policies influence not only the United States, but financial markets across the entire planet. When the Federal Reserve raises interest rates, the world often feels the impact. When it lowers them, liquidity can spread through global financial systems. For investors, these decisions can shape opportunities or risks. For workers, businesses, and households, the consequences can be even more personal. Mortgage rates, job markets, business investments, all can respond to monetary policy. Yet many people rarely think about the institution influencing these forces. The Federal Reserve often operates quietly, far from daily headlines, but its influence continues to shape the economic landscape. Which raises an important question. In a world of complex financial systems, how much control should a central bank really have? And perhaps more importantly, how much should we understand about the system that shapes our financial future?